Moving on, pips, points, and ticks are measurements used to describe price movement across financial markets. A pip, point in percentage, is the standard unit in forex trading and usually represents the fourth decimal place as 0.0001. A point generally refers to large whole number price changes in stocks and indices, such as a $1 move. A tick is the smallest possible price movement allowed for an instrument and varies depending on the market and products you're trading, while pips are mainly used for currency pairs. Points and ticks are common in stocks and futures markets. This unit helps traders calculate profits and losses based on profession and the size of the position you're taking. So, as a beginner, I would advise that you know what pips and what ticks is, what are the difference between these two. So, keep watching while I teach you what these two really means and how they work. So first of all, we're looking at the pip, point in percentage. What is the pip? I know you've been asking that in your mind. The pip, the standard smallest price change in forex, typically for the fourth decimal price or place, which I said earlier, 0.0001. What are the exceptions? For Japanese yen, which is the JPY, currency pairs, a pip equals the second decimal place 0.01. Example, if EUR USD moves from $1.10 to $1.10.55, it moves 5 pips. Do you understand? 1.1050, 1.1055. It moves 5. This and this is just 5 pips. You understand? So what are the points? What it is: the larger unit of measurement often used in stocks and indices. Stocks / indices, a movement from $50 to $51 represent a non-point charge. Forex, the same platforms, the fifth decimal place is called a point or a pipette. E.g., for example, we have 1.1055. So that is the fifth decimal place. So we have for tick. What is tick? The smallest price movement an instrument can make as defined by the exchange. What is the variation? Tick size differs between instruments such as 0.01, 0.25 or smaller. You understand? So what is the usage? Have commonly used in futures and stock markets to track very small prices in changes. What are the key difference and usage? Markets, pips apply to forex, points and ticks are manually used in stocks and futures. So they manually use ticks, not pips in stocks or in futures. They are used for dots, while pips is used for forex. As a forex trader, this is what you should be looking at to learn, not this. So what is the size? Pips are mostly fixed in size. Ticks are vary by instrument. Points usually represent whole units. Calculation: profit or loss is calculated by multiplying the number of pips / points or ticks by the position or contract size.